Right, so I guess we should get started again. So welcome back. I'm Anders, moderating chairing this second part of today's session. Just want to remind you that presentations are 20 minutes, discussion is 15, and Q&A for 5 minutes. I will have signs for 10, 5, and I will hold them up like that. 10, 5, and 1 minute. So that's without further ado, start the presentation of next paper. The title is Financial Media as a Money Doctor, Evidence from Refinancing Decisions. And it's Denis Sosyura that's going to present the paper. So the screen is yours.
All right, thank you very much for having me. This is joint work with Lin Hu, Kun Lee, and Fon Golf on the Australian National University. So the motivation for this paper is that there's really mounting evidence that households make very costly financial mistakes when it comes to various aspects of their financial management. And these mistakes are very costly, and there's been active policy effort to try to help households avoid some of these biases and some of these mistakes. And that effort has ranged from investor education, greater disclosure, protective legislation, and even optimal default and robo-advice. So the research question that we ask in this paper is, is there a role for private information intermediaries to help households avoid or fix those mistakes? And in particular, among the private information intermediaries, we focus on business television. The reason we focus on television is because TV, even now with the greater popularity of the internet and all the technological advancements, it's still the primary source of information for nearly 60% of households, almost 3 times as much as the print media. It's also privately funded, so it seems like it could be a means that has a very wide reach of households. And then with respect to the particular household decisions, we're going to focus on their propensity to refinance when interest rates decline and when doing so becomes financially advantageous. The reason we focus on refinancing is because the home is the largest household asset, and the failure to refinance is one of the costliest household mistakes. It's also a relatively clean decision where we can decide when it would likely be optimal. So we're in the empirical setting, we're going to look at households' exposure to the 3 primary channels of financial television, which is CNBC, Fox Business News, and Bloomberg. And we have 2 channels that we'll have in mind. I will go over those channels in a little while with a little bit more detail, but the role of media that we see or hypothesize about is one of financial education. There are a lot of personal finance shows, there are programs on financial advice, and specifically exclusively dedicated to refinancing. So we like to see if they have an effect on households' refinancing activity. And secondly, even for those households who are already aware of their refinancing options, we believe that there might be a role for a nudge, an extra push against inertia. That could come from market news, the coverage of interest rates, or refinancing ads. Okay, so the key, of course, in the paper is to generate exogenous variation in exposure to television, and we offer 2 methods of doing so. So first of all, we look at the staggered entry of financial TV channels into particular zip codes. An interesting institutional feature of the cable TV market is that the local cable TV market operates as nearly a monopoly. The majority of zip codes have just one cable provider, and the reason for that is that laying cable is very costly. So you have these local monopolies within the county that generates very rich variation, even in geographically proximate locations that are serviced by different providers because of the nature the cable was laid in the 1980s and 1990s. So this is an example of the state of New Jersey, and you could see a lot of spatial variation within the same county. The black lines are the borders of counties. You see at the bottom different cable providers that are matched by different colors. And if you take even one county, let's say Warren County of New Jersey, you see 4 different providers, or you see 4 different areas that are serviced by different providers within the same county, all of which will have different channel offerings. And even when they offer the same channels, they will have them in different order. And we will also argue that the order in which the channels appear in the lineup will be an important driver. So this is the first source of variation that we exploit. Okay, so the second source of variation, conditional on how on a channel appearing in the local cable market, will argue that the channels that appear closer to the lineup, closer to the top of the lineup, let's say as channel number 5 or channel number 10, are significantly more likely to be watched, all else equal, than channels that appear towards the end of the lineup, let's say channel 150 and so on. The reason for that is that households spend about 28% of their time surfing the TV, sort of looking for something to watch. And if the channel appears closer to the top of the lineup, it's more likely to enter their opportunity set. Okay, so the nice institutional feature about the channel lineup is that it is determined by the local cable system, and there are about 10,000 local cable systems in the US that are owned, some of them which are owned by the same providers, and each of these systems has a unique channel grouping rule. Some group channels by the genre, so they will group together entertainment channels and news channels and so on. Some will group together channels by network, so they'll group all the Fox Business channel with Fox News channel and other Fox channels, and some will group them by regional focus. So first starting off with local channels, then national, then international. Also, the way that the networks add channels to their lineup is also different. Some will add channels to the end of the lineup. Some will add channels to the best available slot, which again is determined by which channel is dropped locally. So that generates this idiosyncratic source of variation that we're going to exploit for identifying the effect of TV viewership on refinancing decisions. So let me give you a couple of examples, actual examples. So this is the cable lineup of Colfax Cable Company in Spokane, Washington. You see that in this case, CNBC is grouped together with CNN and Fox News because it's considered that that network views it as a news channel. So CNBC appears in channel 8. Now, if you compare that with Xfinity in Houston, in that case, Xfinity views CNBC as an entertainment channel, and they group it with other entertainment channels like E, Animal Planet, and so on, and it appears in channel 45. So the argument here is that conditional on the channel already being in the lineup, it is more likely to be watched in Spokane, Washington than in Houston because of these channel allocation rules. And we'll exploit shocks to channel allocation rules from things like channel regroupings that from system upgrades. Okay, so this is just a graphical illustration that channel the ordinal positions of channels matter for viewership. You could take a look and see that generally those channels that appear closer to the lineup are more likely to be watched. So the same channel will see about 15% more households if it appears one standard deviation closer to the top of the lineup. Let's say it's channel 15 versus channel 50. And the idiosyncratic variation that we're going to exploit here is what the one that's driven by the media allocation rules, the available local slots in that given market. So let me give you a preview of the findings, and I'll provide a little bit more detail thereafter. So the first main result is that exposure to financial television increases households' propensity to refinance their homes. So the entry of a new channel increases the propensity to refinance by approximately 14% when refinancing becomes advantageous. Since we don't have information, all the detailed information on every single household, you know, things like, are they going to move? What is the equity in their home, and so on. We assume that refinancing becomes financially advantageous when interest rates drop by at least 100 basis points, which would swamp most of the individual factors. We also confirmed that the effect of TV viewership on refinancing activity using this ordinal channel of the position as an instrument for viewership. So we find a similar but significantly economically smaller effect in zip codes where a given channel appears one standard deviation closer to the top of the lineup. The refinancing activity increases by 3.5 percentage points more when it becomes financially advantageous. With respect to the mechanisms, we identify the dominant mechanism is just a greater fraction of refinancing households, so the extensive margin. But there's also more comparison shopping on the intensive margin, so the greater propensity of households to submit multiple applications. And finally, there's an interesting channel that suggests that maybe media helps fight some of the inertia or overcome some of the inertia by helping households are more likely to complete their initiated applications, perhaps getting extra reminders. So where's the main effect? The main effect sort of relates to households that seem to be in the greatest need of financial advice. These are minorities, lower income households, and lower financial literacy households that perhaps have fewer other alternative sources of financial advice. An important implication of the study, we believe, is that it is for these particular households that lack other sources of financial advice that the economic effect is likely to be the most important, because refinancing will likely matter the most for their solvency and disposable income. So to summarize, this is a paper that suggests that media could serve as an educator and a nudge against inertia and serve as an alternative source of financial advice. Okay, that's the paper in a nutshell. Now a little bit more about why we're interested in studying the effect of media on refinancing decisions. So we believe that there are two ways that media could help households as a source of financial advice. So first of all, there's this financial awareness and education channel. A lot of the business channels have programs that are specifically dedicated to a particular financial decision, in this case, the refinancing decision. Fox Business ran an entire series called Refi Nation for 3 years, where they would have different segments on when to refinance, how to choose the provider, when is the best time, and so on. Aside from these dedicated programming, there's also personal finance shows where people call and ask questions about refinancing, or where refinancing becomes the focus of a particular program. Aside from this financial awareness and education channel, perhaps for the less sophisticated households, we believe that there is also room for an effect for households who are already aware of the options to refinance. But so if we look at the existing research, one of the key reasons that, or some of the key reasons that are suggested by the authors for the failure to refinance are inattention and procrastination. And this is when the authors call up the households who fail to take very advantageous offers to refinance that are pre-approved, that have zero essentially cost, and it seems very suboptimal to fail to refinance, and the main reasons are inattention and procrastination. So what we argue is media perhaps could help increase the attention to interest rates by the fact that these interest rates appear as part of the ticker tape. They're salient reminder in many of the business channels, and Bloomberg, for example, which would show you the current interest rates. There's also significant developments in the mortgage market that are covered as part of the general business news. For example, you will see headlines like a plunge in mortgage applications, a plunge in mortgage rates sparks refinancing on Bloomberg. So just again reminded about this refinancing options. And lastly, just refinancing advertisements, which are very popular on business channels, gives you an extra nudge to follow up on these refinancing opportunities. Now, is this true in reality? So do consumers really use information from the media. So here I would like to give you information from the National Survey of Mortgage Originators. So this is a survey of people who took out a refinance and mortgage, 8,000 respondents in a nationally representative sample. So where do they get their information in their refinancing decision? Well, the most popular ones, as you would expect, are lenders or brokers, financial planners, but media seems to play an important role. About 16% of borrowers take some information from the media in their refinancing decisions. So it's comparable to the role of real estate agents, and it's about 3 to 4 times greater than the role of housing counselors, which has been the primary effort of, which has been the main effort of the government policy. Okay, so where does the media have greatest effect? These are the households that traditionally are underbanked. So these are seniors, minorities, less experienced households. So this is where we would expect to have the most bite. And some primary evidence from just naive regressions. This is where we're looking at how those borrowers that rely greater on media or rely on media on their refinancing decisions, what do they do differently in the refinancing process? Well, they tend to self-initiate the refinancing process more often as opposed to just responding passively to other offers. They are more likely to evaluate multiple lenders, so more comparison shopping, and they're more likely to refinance again in the future, suggesting perhaps a slightly more educated, more aware, financially aware approach to these decisions. So that's our motivating evidence. For the data, we use very detailed data from Nielsen on zip level penetration of different channels and the ordering of channels at the zip code level. For the refinancing activity, we essentially use the universe of nearly all refinancing applications of the last several decades. The data is very detailed at the application level. We can observe both approved and denied applications, so we can separate the demand and supply effects. And we can observe a lot of the borrower activities, such as withdrawal of an application, leaving an application incomplete, accepting or rejecting a bank offer. All right, so now the main results. So just to start off I'd like to start off by kind of validating channel entry as a reasonable identification strategy and showing you that there's no pre-trend in refinancing activity before the entry of business channels into given zip codes. Whether you look at the number of refinancing applications or the amount of refinancing applications, there's virtually no difference between the control and the treatment group. So I'm going to give you the results for the Fox business channel because I think it focuses mostly on, so it's the channel that focuses the most on our primary clientele of middle class, the mortgage borrowers, and I'll show you the results for Bloomberg and CNBC as robustness test. Okay. Here's the baseline result. This is the effect of the entry of Fox business channel into a given zip code. And what we see here is that after the Fox Business News enters the zip code, investors or local residents become more likely to refinance, but only when refinancing is beneficial. So again, we define refinancing being beneficial when interest rates drop by at least 100 basis points. As you can see, there's no increase in refinancing activity if there's no change in interest rates. So these seem like value-adding refinancing decisions. And in our identification, because we have very detailed zip level data, we can absorb heterogeneity, time invariant heterogeneity across zip codes using zip code fixed effects. And we can also control for any level of activity at the county year fixed effect. So looking at the same county within the same year and just exploiting the variation across the zip codes. Okay. So if we look at the effects in event time, it takes about 3 years for the full effects to take place, again, as long as the interest rates stay low. So the effect of channel entry on mortgage refinancing activity grows during the first 3 years and then gradually levels off. Okay. How does this affect household activity? So here we're are looking at two measures of household activity, what we can observe. So the first one is their searches for, local searches for refinancing providers. So this are Google searches that we can identify using the IP address of the searching household. And we see that local residents tend to increase online searches for refinancing after the entry of the business channel. This is consistent with this education channel. Perhaps they're looking for different providers, or they're looking to learn more about the refinancing options that they heard about on TV. And secondly, they're more likely to complete their refinancing applications. We see a drop in the fraction of applications that are left incomplete, which is consistent with what we believe is a nudge channel. So maybe they become more active and less procrastinators. So the effects are similar for the entry of Bloomberg and CNBC in economic magnitude. They're about half of the effect of Fox. Well, perhaps because they're dealing with slightly different audiences. Bloomberg is mainly financial professionals, and CNBC is more of higher income consumers. Across borrowers, as I mentioned before, it's stronger for minorities, moderate income groups, government supported borrowers. So those groups that tend to rely more on refinancing decisions and perhaps lack other sources of financial advice. And across different locations, the effects are stronger for areas with lower scores of financial sophistication, and they're stronger when there's some physical branches nearby so that consumers could submit their application. Perhaps physical proximity is important. Okay, now let me finish off with validating the research design that was based on the entry of business channels into zip codes and exploiting spatial discontinuity into looking at all the zip codes that already have business channels but have them in different positions. So here's the result from the where we're exploiting variation in the ordinal position of business channels. What we find here is that for those zip codes where the ordinal position or where business channels appear closer to the top of the channel lineup, local residents are significantly more likely to refinance their homes when interest rates drop. The magnitudes are smaller than for business entry, but they're still significant to the tune of 3.5%. Okay, so let me go ahead and conclude to make sure we stay on time. We argue in this paper that exposure to business television increases households' propensity to refinance their homes, and they do so only when it's financially advantageous. And kind of the broad message of the paper is that media could be an alternative information source, an intermediary to reach some of the underbanked households. Thank you very much for your time.
Thanks a lot. Discussant is Kasper, Meisner, Nielsen from Copenhagen Business School. The screen is yours.
Thanks. So Denis, I'm just waiting for you to unshare your slides.
Mm-hmm.
I think you need to...
Yeah.
Okay.
Just a second.
Okay, so there we go.
Thanks.
Okay, so here we go. All right, so thanks a lot for letting me discuss this interesting paper. Let me just start with saying that I think this is an important area to work in that there is a lot of documenting that households fail to refinance when it's advantageous for them, and that the cost associated with failing of refinancing is very large. And so what this paper is looking into is essentially how can we help households make the right decision. Here, the paper is exploring the role of the financial media using an identification strategy that is sort of exploiting staggered introduction of business networks and channel reshuffling in the US. And what they find is that there's a very large effect of exposure to financial media, and that the households are much more likely to refinance when it's advantageous. if they're exposed to the financial media. And this is an effect that is driven by, you know, the sort of otherwise disadvantaged households, and that is driven by minority and low-income borrowers. So this is sort of something that, you know, potentially has strong implications for welfare. In terms of the contribution of the positioning of the study, I mean, as Denis also mentioned, right, there's a large and growing literature on refinancing, documenting that households fail to take advantage of falling interest rates and refinance their mortgage. And there's a discussion of sort of what drives that effect, and it's been documented that sort of inattention, inertia, and financial literacy is in, you know, contributing to the failure to refinance. So, and the main contribution of Denis's paper is sort of to try to come up with a piece of evidence that is addressing this issue that is actually very difficult empirically to disentangle inattention, inertia, and financial literacy. So inattention is just a failure to pay attention to opportunities that arises. So in other words, households are reacting too slow to when their incentives are changing. Inertia or procrastination is just a failure to take any action. And obviously financial literacy is a sort of the inability to understand that it was advantageous for you to refinance your mortgage. And I think sort of the main contribution of the paper is sort of just to show that this exposure to financial networks is increasing the attention to falling interest rates, and thereby leading to increases in refinancing. Alternatively, it reduces inertia. From the current version of the paper, you kind of sort of tell which of these two dimensions are really being triggered by the financial or exposure to financial media. And there's a couple of key identifying assumptions here that are obviously important for us to be able to appreciate the findings here, and that's that this staggered expansion of cable networks is exogenous to refinancing opportunities, and also that you know, these channels reshufflings also are exogenous relative to refinancing incentives of households. In thinking about sort of, you know, trying to figure out what's the you know, the driving channel for the increase in refinance rates. So here's just a figure from you know, a paper that I wrote with co-authors where we looked into refinancing activity among Danish households. And what we are plotting here is essentially a Kaplan-Meier survival curve, conditional on having positive incentives for a given household. So you see here at the beginning of the period, you know, in the first period where households have an opportunity to refinance, it's actually a very small fraction of households that takes that opportunity. And as they sort of have continuous spell of positive incentives, more and more households will actually, so to speak, wake up and refinance their mortgage. And you can think of this as sort of roughly being, you know, a part of the activity that is being, or inactivity that is driven by inattention. So failure to pay attention to the fact that the interest rates have been falling, and therefore it has been beneficial to refinance your mortgage. And then there seems to be a flaw to this effect, which is sort of the inertia effect, the fact that households are never responding to the falling interest rates. And then if you think about sort of the curvature here of the solid line, right, is sort of how households respond over time to incentives to refinance, you can think of this as sort of being refinancing efficiency, right? So obviously the quicker they respond, so in other words, the steeper the solid curve here, right, the better a financial system we have, or it's a system where we are allowing households to take advantage of refinancing opportunities, right? And obviously the flatter the curve, the worse it is in terms of household outcomes. So what I think would be really interesting here, if the authors could sort of push this idea and sort of show us how these sort of refinancing efficiency is essentially being shaped by financial media. I think that's kind of the takeaway that this paper potentially can deliver to the literature, sort of understanding how this curve here, you know, is essentially being shifted by exposure to financial media. And what we would think is that they're not just refinancing, but that they're also quicker at refinancing once incentives to refinance arises. All right, so I think the main research question here is whether sort of financial media can improve the refinancing efficiency. And I think that's sort of what I would push the authors to think about in the future revision of the paper, and how can they sort of, go beyond just documenting that financial media makes refinancing more likely, but also in terms of trying to tease out what's the underlying channel and what's the implication for refinancing efficiency of the general population. If we look sort of into the identification strategy, so most of the current paper is using sort of, or at least using Fox business network expansion as sort of the main case, and then it's showing that similar results for the two other networks. So this is just, picking on the author's figures. And, one concern here is that most of this sort of expansion of Fox business network is happening in the years after the financial crisis. And so that's sort of the period in which we have falling interest rates. And that to some extent brings up this question of whether sort of, when we do this diff and diff setting, whether we're really picking up a time trend in the data, that it coincides with the expansion of the network. And to some extent, I think the authors have the data to address this, because they have two other networks that might have expanded at different points in time, and therefore would have expansions that are not necessarily correlating strongly with changes to the interest rates, which was sort of the concern you would have when you look at the figure tree. The other concern you might have is once you look at the test of parallel trends, you would note here that there's a very large difference in baseline refinancing activity between the treatment and control group prior to the entry of the business network. And to some extent, that's concerning, because it really tells you that there is, some, observable difference between the zip codes where the business networks are entering versus the zip codes where they already were, or where they decided not to enter. And I know that the parallel trend assumption is just looking at whether there's a parallel trend in the slopes of these, right? But the concern here is obviously that the treatment group is essentially, in zip codes that seem to be in general much more likely to respond to incentives to refinance. And I think that's something that the authors want to concern. And what comes to mind here is maybe perhaps matching on observable characteristics would be helpful for the authors, sort of trying to sort of close this gap between the treatment and control group. In order to convince the reader that there is a staggered expansion of the cable network that is unrelated to refinancing opportunities, they're running sort of an empirical model here that looks into determinants of the entry. And what you note here is that there's just a lack of stars. So it doesn't seem to be the case that, the incentive to refinance is predicting entry. One concern though with this regression is that it has fixed effects in here. So there's the inclusion of country year fixed effect and zip code fixed effect. And that implies that this regression is a change regression. And that might not actually capture the decision to enter. So I think this is a regression that should be in levels. You want to see whether you can predict that they're entering into specific zip codes faster than others. That also suggests that the analysis should not be a panel data analysis, but should be a survival analysis, unless that there are exits from the sample as well. So I think sort of there's more work to be done here. What I would like to see is just, I would like to get a better understanding of what is it that predicts entry. And again, if it's factors that are unrelated to economic conditions or factors that are unrelated to the incentive to refinance, then the authors have this beautiful exogenous variation that they can exploit. So just the fact that there are no stars is a bit of a concern here, because there must be something that drives the network's decision to enter into a specific location before another location. And maybe that has nothing to do with refinancing, but it would be nice just to get a better understanding of what is essentially driving that decision. It cannot just be completely random. A little bit similar with the channel reshuffling. So I think that's arguably more exogenous, but the downside obviously is that the economic magnitude of that shock is going to be smaller. The authors mentioned that the reshuffling happens primarily because of network defaults. So some channels get pulled, and that creates a vacancy. And then there are some rules at the local level that determines which of the channels get reshuffled. And the concern is that here, clearly maybe the decision of the vacancy, maybe that's random, but the decision to fill the vacancy, that doesn't strike me necessarily as being random. And so it'd just be, again, nice to have some more examples, some more illustrations of what determines that, and in order to convince the reader that that has nothing to do with the incentive to refinance. And it's not that I don't have any sort of necessary smoke here. It's just that it's just nice to get a better understanding of that, what drives the decision, because otherwise it's hard for me to ascertain that the exclusion restriction here is being met. Okay, so let me spend the last few minutes on sort of some suggestions for how to amend the paper and push it along towards publication. So I think it's an interesting question. It really deserves the attention, and sort of I think that there's a path to a top publication here. What would I do if I was working on the paper? I would really like to see some, it might be cherry-picked examples of zip codes in which Fox Business News were expanding, compared to the close neighboring zip codes, and then just show me before and after what's the change to the refinancing rates. So at least have some examples that helps build the story such that I gain trust in the estimates from the econometric analysis. I would also similarly like to see some simple descriptive charts that shows before and after, with some matching, such that I can ascertain that the effects are driven by the treatment group and not the control group. Then I think there needs to be an improved test of the expansion of the network. So what is driving that? I don't think it can, it's reasonable to argue that it's completely random, but maybe it's exogenous to mortgage refinancing, and that's what the authors want to illustrate. So it'd be nice to just see that they can actually predict entry along the dimensions that you'd expect, but that it doesn't correlate with refinancing opportunities. And then I would like to see more discussion of sort of the economic magnitude. What's the effect of financial media on the refinancing efficiency? In other words, how much is it pushing, in order to get us closer to, the optimal outcomes for households. And then maybe there's an opportunity to supplement the analysis with Google Trends data, because if we sort of go along with the author's story of the fact they're getting exposure to financial media, then I think the most likely scenario is that then households will simply Google refinancing, right? So once they get sort of this notch that they need to refinance, then the next natural step would be to figure out, how do I refinance my mortgage? And I think that would show up in Google Trends data. So maybe that's something the authors could exploit to the extent that that's possible at the sort of geographic frequency that they're using. Then I think, there's some obvious omissions that I think is just a matter of, this being an early draft. I think it's important to control for differences in incentives to refinance across locations. So right now, the identification is coming through falling interest rates, but the incentive to refinance depends not just on the movement in interest rates, but also what mortgage do you already hold? What's the maturity of the mortgage? What's the size of the mortgage? What's the fixed cost of refinancing? And I think it would be important for the authors to convince ourselves that what we are comparing across locations is essentially similar loans, and then that we show differences in the propensity to refinance that loan, given that interest rates have been falling. And then finally, I think it's important to be able to distinguish between optimal refinancing and suboptimal refinancing. So in the literature, there's a lot of discussion about errors of commission. So refinancing, even when interest rates have been falling, might not be optimal. So if you just took out your mortgage and the interest rate savings, between the current market rate and then your old mortgage rate, if that's lower than the average being calculated by the authors, then individuals might make a mistake. And so it seems to be, again, important to try to demonstrate that the evidence is indeed driven by optimal refinancing. I think this is sort of just natural, steps in the process towards pushing the paper towards publication. So good luck.
Thanks very much, Kasper. That was 15 minutes on the second. I can't see any raised hands here yet in the chat, but Maybe you want to respond then, Denis?
Kasper, thank you very much for the detailed discussion, all the great suggestions. All the points are well taken. I think perhaps the biggest question that you asked was what drives, why do they go for some markets before they go for others? And what we've been able to find kind of more recently is that population is a factor, so the potential size of the market. Okay, so they want to go for larger markets first and kind of branch out from there. And larger, when I mean larger market, this is at the level of the state. So what we do exploit is that, let's say if they go for the larger market of Texas or California or New York, what we exploit is the differences between zip codes in the state of New York or New Jersey or Texas, the ones that are covered by Fox versus the ones where the monopoly is by Xfinity or Cox or any other provider. So what we hope is that that gives us kind of quasi-random variation within the state, and given that we run all the analyses with county here, fixed effects, given that you did enter into New York and Texas and California before, but what we use is within New York, within California variation, and that seems pretty random. And that also, I think that also reconciles your question about why. So we do see parallel trends, but why are the levels different? Well, the levels are different precisely because the zip codes they enter, they have more people, so they have a greater volume of refinancing activities. So the proper way perhaps to do that chart would be maybe do like refinancing per capita, and in that case, there would be pretty similar matching lines. Thank you again.
So unless there are any other questions, we can move on to the next presentation. Kasper, if you want to unshare your screen, please.